You might be wondering, and the reason I think you might be wondering is when I teach this concept in the classroom, invariably I'll get a question from a student where they ask, what if you don't use the asset for the full 5 years, for the entire useful life? Well, that could be the case. Now, what we want to do here is we want to see what's the impact if we sell this asset midway through its useful life. I'm going to use the straight line depreciation method because, number one, it's the simplest. Number two, it's also the most commonly used. So you might remember this if you watched the depreciation video already. You might remember what we did with straight line depreciation. We essentially took the cost of the truck to place it in service, which was $70,000. That was the purchase price plus the snowplow and the accessories. And then what we did was we assigned a residual value of $10,000. So we have a depreciable cost of $60,000, and we spread that out over 5 years. Each year we record $12,000 of depreciation expense each year for 5 years, and the accumulated depreciation grows by $12,000 each year. The net book value simultaneously drops by $12,000 each year for the next 5 years. At the end of the useful life, your residual value is $10,000, which is exactly equal to your net book value at the end of the useful life. So what we want to do now is let's assume that we sell this particular asset in the middle of its life. So we're selling it at the end of the 3rd year, and let's just say we sell it for $40,000. Now, at the end of the 3rd year, the net book value of this asset is $34,000. We have the historical cost of $70,000, and the accumulated depreciation has grown to $36,000. To just kind of keep in mind and have a reminder here, these are 2 separate accounts in the company's chart of accounts, 2 separate accounts in the balance sheet. One is a positive asset, one's a negative asset. Combined or netted together, they produce the net book value. So what happens if we sell this asset for $40,000? So the proceeds are $40,000. The net book value is $34,000. That's going to produce a gain of $6,000. Think about the reason that's a gain. What's essentially happening here, the company is trading a $34,000 asset for a $40,000 asset. A more liquid one in that regard as well, because it's taking the asset truck and equipment, $34,000, trading it for cash, $40,000. Anytime your assets increase, you've got a scenario that causes gain. Of course, it's possible that we receive less than the net book value when we sell the asset. Let's just assume we're still selling this asset at the end of the 3rd year. So the net book value is still $34,000, but now your sales proceeds are lower than the net book value. In this case, let's assume the sales proceeds are $30,000. Okay? The net book value is still $34,000. What is going to happen here, this is going to produce a loss, okay? A loss of $4,000. Because what we've effectively done, we've taken an asset that is on our balance sheet in an amount of $34,000, and we've traded it for an asset cash that's only $30,000. That's a scenario for generating a loss. So what's going to happen is after we record this loss, the vehicles account would become 0. Okay? So this will become 0 because we're going to get rid of the cost. We will also get rid of the accumulated depreciation as part of the bookkeeping entry, and the net book value will drop to 0. So the asset goes away on the balance sheet, and then what happens is the income statement will record this expense, and then the retained earnings of the company will decline because the expenses cause net income to be lower. In the gain situation, we would still have the asset become 0 on the balance sheet, but the gain would act to increase our net income on the income statement, which would ultimately increase retained earnings on the balance sheet at the end of that period. What if we look at a very extreme example of a loss. What if we just simply have to scrap this particular asset? So maybe we crashed the truck and we did not have insurance on it, or something like that. Now, mid-year, hopefully we would have insurance on it, but extreme example. We just put it in the scrap heap. We received nothing for it. So your proceeds are zero. Your net book value, just like with the gain scenario and just like with the loss scenario a minute ago, it's still going to be $34,000. That's still the asset you're getting rid of. What happens is, if you scrap an asset, receive no proceeds, your loss is going to be equal to your net book value. Because in this extreme example, what you're doing, you're taking a $34,000 asset and you're exchanging it for nothing. Now, fortunately, that doesn't happen frequently. A lot of times there's insurance that will kind of come in, and insurance might be the proceeds for disposing this asset. When you maybe have a catastrophic event, some kind of a casualty. But we do see sometimes as an asset gets close to the end of its life where we would dispose it with no proceeds. A lot of times in that case, however, the asset does not have a net book value. In that case, let's assume that this thing was fully depreciated, even down to zero net book value. If you scrap that asset, the only thing that's going to happen is the vehicles go to zero, the accumulated depreciation goes to zero, and then there would be no effect on the overall accounting equation. Assets would stay the same, liabilities are unchanged, and because there's no impact to retained earnings, there would be no change. Because there's no profit or loss, there's no change in retained earnings. Essentially, it's just getting rid of the asset in the accumulated depreciation account.